Palantir Technologies stock jumped more than 10% after its latest earnings report, and this move was not driven by hype alone. It was the result of strong quarterly results, clear beats versus expectations, sharply higher guidance, and evidence that future revenue is already locked in. Coming into earnings, Palantir had been under pressure. Software stocks had sold off, investors were worried about valuation, and there were growing concerns that artificial intelligence could eventually disrupt traditional software companies instead of benefiting them. Palantir's earnings report directly challenged that narrative. Starting with the headline numbers, Palantir reported fourth-quarter revenue of $1.4 billion, representing 70% year-over-year growth. Wall Street analysts were expecting closer to $1.3 billion, making this a clear and meaningful revenue beat. Earnings also exceeded expectations. Adjusted earnings per share came in at 25 cents, up from 14 cents a year ago, and above analyst estimates of 23 cents. Palantir beat on both revenue and earnings by a wide enough margin that it could not be dismissed as a minor upside surprise. However, the biggest driver behind the stock's move was guidance. For the first quarter, Palantir guided revenue to roughly $1.53 billion, well above the approximately $1.3 billion analysts were modeling. For the full year, the company guided revenue to about $7.2 billion, compared with expectations closer to $6.3 billion. When guidance moves this far above consensus, analysts do not simply make small adjustments. They are forced to rebuild their models, and that often leads to rapid repricing in the stock. Looking deeper into the quarter, the most important story is where the growth came from. U.S. commercial revenues surged 137% year-over-year to $507 million, well above expectations. U.S. government revenue also jumped 66% to $570 million, exceeding forecasts for that segment as well. This growth was not driven by international expansion or one-off contracts. It was driven by accelerating demand in the United States, across both commercial enterprises and government customers, at the same time. Another key reason the market reacted so strongly is bookings and backlog. During the quarter, Palantir closed over $4.2 billion in total contract value, up 138% year-over-year. Commercial contract bookings alone reached $2.6 billion, more than doubling from the prior year. Remaining deal value now stands at over $11 billion, up more than 100% year-over-year. This indicates that a significant portion of future revenue growth is already contracted rather than speculative. Customer behavior has also structurally changed. Palantir is no longer selling small pilot projects. New customers are starting with large, production-scale contracts almost immediately. Existing customers are expanding rapidly, pushing net dollar retention to 139%. At the same time, revenue growth is far outpacing customer growth. Palantir ended the quarter with 954 customers, up 34% year-over-year, but revenue per customer is rising much faster. The company's top 20 customers now generate an average of $94 million each in annual revenue, up 45% from last year. This shows Palantir is becoming deeply embedded inside fewer, larger institutions, rather than chasing volume. Another underappreciated part of the report was profitability. Palantir generated over $600 million in GAAP net income during the quarter, representing a net margin of approximately 43%. Adjusted operating margins reached 57%, and the company's Rule of 40 score climbed to 127. This directly contradicts the idea that artificial intelligence-driven growth must come at the expense of margins. Palantir is growing faster while becoming more profitable. Management also made it clear that Palantir is not demand-constrained. In fact, the company stated that U.S. demand is so strong that it does not currently have the bandwidth to aggressively pursue more complex international deployments. As a result, growth is being deliberately concentrated in the U.S. market, where returns on engineering and deployment capacity are highest. This reframes slower international growth as a strategic choice rather than a weakness. On the government side, Palantir is evolving beyond analytics into operational and industrial platforms. New deployments, such as ShipOS for the U.S. Navy, are designed to modernize supply chains, production planning, and delivery timelines. This positions Palantir less as a traditional software vendor and more as an operational platform embedded in critical national infrastructure, meaning software that institutions rely on to run core operations, rather than optional tools they can easily replace. Ahead of earnings, Palantir's Chief Executive Officer, Alex Karp, acknowledged that artificial intelligence could eventually disrupt any technology company. However, he emphasized that Palantir invested in this technology years ago and built its products and culture specifically for this phase of AI adoption. He described Palantir as a different species of company, designed for real-world deployment rather than experimentation. When everything is taken together, the stock jumped because three things happened at once. Palantir delivered a clear beat on revenue and earnings. Guidance came in far above expectations. And growth accelerated while profitability expanded. That combination forces a reassessment of the business and often leads to a repricing in the stock, especially after a recent sell-off. The key question going forward is no longer whether Palantir can execute, it is how long this pace of growth can last, and how the market ultimately values a company that increasingly looks less like a traditional software firm and more like critical infrastructure.